Hello and welcome to the Cube Talk Show. My name is Joe Barbieri. I'm your host for this evening, and this is a money show. We talk about all aspects of money. Tonight's guest is Ken Thomas. He is a financial consultant with Investors Group. The topics for tonight are financial planning, estate planning, and insurance. So first off, Ken, how are you?
I'm good, thank you. Very good, thank you.
So as a beginning, tell me about your background, and well, we know that you're with Investors Group, but
Okay. Well, my background, I started off in Royal Bank as an auditor, and then I moved into the financial planning world in 1999 as an assistant, just doing basic paperwork. Eventually, I moved on to becoming an associate advisor, first at Berkshire Securities Investment and then at Blackmont Capital Inc. And then I moved over to Investors Group as a consultant. So I basically moved up the ranks.
okay.
I did 2 financial planning designations just to, have that added value.
Okay.
Yeah.
So I guess starting with the simplest, financial planning. So at the very basic level, what do you tell people when they first come to you?
First of all, when we talk about financial planning, we talk about having a plan. People have different ideas of what a plan is all about, or a financial plan. It's not sitting and winning the lottery. It's not that. Having a financial plan entails budgeting. It entails proper savings. It entails retirement planning. So when we talk about financial planning, we talk about having a financial GPS. How do you get to the next step? How do you accomplish your financial goals? So what I say to individuals, the first thing you have to do is to pay yourself first.
Okay.
And they ask me, well, what is paying yourself first? It's simply when you get your income, you should put some of that money into your own pocket. How much should you put? And that's based on your budget. So you should be looking at doing a bit of budgeting before anything happens. Once you've done your budget, you decide to, I'm going to pay myself first. Some people say, well, I don't have money. Where am I getting money from?
Yeah.
And that's when I go into the fact that, let's look at, for instance, buying coffee every day. There are people who love buying Tim Hortons. I'm not beating up on Tim Hortons. I mean, I like coffee as well. But let's look at Tim Hortons. Every day you see these long lines of people buying coffee.
Yeah.
And I'm saying if you cut down on that, you would save money. If you calculate how much money you spend on coffee every day for the next 10, 15 years, you will have a down payment on a property. Lunch. Every day, lunch is costing about, I don't know, $10. $10 per day, that's what, $50 per week, that's what, $200 per month. It adds up. Dinner, same thing. You spend $50 on dinner, or if you're with your friends. These are the areas where you could start looking at to start putting aside money for yourself, whether it be to purchase a home, to purchase a car, but you must have a reason for savings. And then we look at your retirement plan comes into play as well. When do you start planning for your retirement? You start planning for retirement when you start working. You don't wait until you're close to retirement to start.
60?
Exactly. So you should do that at the onset. But I always encourage people to start saving early because of the time horizon. So some people say to me, well, I got a late start, but it's better you start than never start at all.
Okay. Do you ever have any unusual scenarios like?
Well, I could give a quick scenario. There was this individual who was they were making about $2,000 a month, and they had their rent to pay of about $400. It was shared rent, and so after the rent, they had about let's say $1,600 remaining. And they're like, what am I going to do with the $1,600? But I shared with them, without a plan, it's going to go to waste. So they wanted to purchase a home.
Okay.
So they decided to save about $1,000 a month from the $1,600 because there was a plan in place. I need to get money for a down payment, but I want a huge down payment. So in over a 2-year period, they were able to save close to $20,000. And what they did, they purchased their first home as well as they purchased a brand new vehicle at the same time. But it happened only because there's a plan in place. I have another individual, a young lady. She said that she could not save. It's difficult to save. When I went through the budget with her, a lot of her money was being spent on dinners and shopping and different stuff. She didn't have a plan, so there was no reason to put aside money. So I said, what do you want to accomplish? What do you want to do? She said, well, I really would like to have my own place. At the time I spoke to her, she was about 20 years old. She's now 25. She has her own business, and she's now looking at actually purchasing a home. What she did, she stopped going to dinners every day or every evening, and now cut back on that. So there was more money available for her to put aside. And I'm proud to say that she's actually doing extremely well. And now she's an advocate to other young people to start putting a plan in place and start paying yourself first. And now she's actually at that place where she has a good chunk of money to actually purchase the home that she wants for herself. That's just one really good scenario.
So the key is to know what you're going to do with the money.
Yes,
at some point.
Yeah. It's like life. Like I always tell people, if you don't have a plan, if you don't have any goals, you're living in vain. You're not doing anything with yourself. And there's a lot of individuals who need that type of advice to help them with a plan and help them, to move forward, motivate them to move forward. The plan can be accomplished with discipline and dedication. So you've got to have the dreams. You've got to believe that it's possible. I tell people you must begin to walk in your dreams. If you want to purchase a home, start looking. Start walking and looking at different homes that you may like. So you attract. You bring all that thing into being. You bring it to life, and that way it will happen. Most definitely.
So do you ever encounter people that say, well, I've looked at the budget and I've cut many things, but I just can't make it. My income is just too low.
I have met tons of people who say that, but there's always money there. There's always money there. I spoke to a young lady a couple of weeks ago, and she said it's impossible for her. When I went through her budget, a lot of her money was spent on personal items, on the hair, on the makeup, on the nails, and I'm thinking, do you spend $500 a month doing all this stuff? And I asked, has it allowed you to move forward in life? And she said her problem is that she really spends too much money on things that are, not super important. She could minimize. So I set up on a plan where now she's saving, she's saving $300 per month. Sounds like a small amount, but as the income increases, she'll just top that up. But now there's a discipline in place. She knows that she has to save $300 per month, and she's looking at purchasing a condo in the next 3-4 years, and also paying off some of her debts as well. But
So,
before that, there was nothing going on. Nothing. She was.
So does the debt come into the picture as well now?
Yes, as well. So we have to decipher how we're going to get rid of some of your debt. So some money is applied to paying off your debt as well. So let's say when I do your budget and I see you have about $500 available after I've chipped a couple of things, I say, so we put a portion towards paying off your debt and a portion towards investments or savings or even life insurance, depending on the individual. So a family would be different than a single individual. So each person has a different situation. So the plan is never really the same. It would probably be different for a household of a wife, two children, or a single man or a single woman or a single parent. It's going to be different. But the key thing, the similarity is that you have a plan that is going to be put in place for you.
So, so at what point does it become a retirement plan, the estate plan? I assume you start with that, and then as it builds.
Yes, exactly. So it's good to have your a retirement plan in place. I mean, the RSPs, for example, it's a good way to start. The retirement plan comes a little bit later, but technically it's already began once you've started to put money aside for your RSP. Now, your RSPs can be used also for first-time home buyers if you're buying a house for the first time. But usually it's for retirement. So starting with your RSPs early is also a good thing. Eventually, the retirement planning will really kick in late on. When you're nearing your that retirement, or you're thinking about retirement. But if you've had the RSP running all these years, that's one part of it done. You can use non-registered vehicles. You could use life insurance as well as a retirement a tool as well. But that's really in-depth thinking. But generally, just starting off with your RSP portfolio it's a good start.
Okay. And so is there a time, I guess, we'll say if somebody is 50 or 55.
Well, it depends on, well, we know retirement age has changed now to, I think it's 67, so it will be at 65. So usually you find people in their 50s are now starting to look at retirement because they have another 15 years or they want to retire early. So that's when they start talking, do I have enough money to retire? So again, it's all about planning. What type of retirement do you want to have? Do you want to retire in living the same lifestyle that you're living? Are you going to be traveling? Do you want to go back to your country where you were born, for instance? Do you want to go to Florida? It depends on the type of retirement that you want to have. Again, we come back to the planning aspect of it. So if you tell me you want to travel a lot, do we have enough money for you to travel? Are you going to stay in your home? Are you going to get money from your residential property? Are you going to sell it? And what exactly are you going to do to come up with this money for spending, for traveling? Are you going to downsize, for instance? So again, what type of retirement do you want to have? So I try to work with clients to give them a retirement check. So what is my check going to look at retirement? Where is money going to be coming from for that check? So you're gonna get OAS, old age security. You're gonna have CPP, for instance. If you belong to a pension plan at work, you're gonna get money from your pension. You're gonna get money from your RSPs if you have rental property. So we sit with clients. We say, okay, where are you going to get your retirement check from? So we look at the different areas where you're going to get that retirement check from, and we calculate how much it's going to be. Inflation included as well.
Yeah.
And we're going to look at, in the next 15 years, can you survive on $3,000? Can $3,000 today buy, what is going to be buying in the next 15 years? So we try to, get that retirement check for you, but it's based on your lifestyle. Right now, seniors, they spend more money now than before because they're more active, they're living longer. So it's going to be more money that they would need. Seniors are the ones that have more debt now, apparently.
Is that right?
Yeah, because they're living longer, they're spending more money doing more activities than before. Also, when you think of long-term care facilities, that they're going to be in these long-term care facilities longer, because new medication, they're living much longer.
So in terms of retirement, I guess what you're saying is back to the GPS idea. So if you have a location of whatever, such and such a lifestyle,
yes,
as you approach it, your lifestyle might shift to I want to do this instead, or I want to add this.
Exactly.
So the target moves, and then you have to see if your plan will
That's right.
get you to the target.
Exactly. So it's about in retirement, what type of lifestyle, and your lifestyles can change too as well. But if you want to be traveling during retirement, what type of paycheck do you want, or retirement check do you want? We've got to look and see all the areas that money is going to come from. As I said, OAS, CPP, if you have CPP, if you worked and you contributed to CPP, your investments, RSPs, non-registered investment, property, life insurance. All these are areas where you can actually get income from during retirement. How much you're going to get should match your lifestyle. You have to be realistic too as well. So I work with clients to get a retirement check for them, and normally people start thinking about retirement in their 50s. Normally they start thinking, so I have another 16 years to work, I have this much money. I may want to take my CPP earlier, depending, some people do that as well, but usually they start planning between, I think, 5-10 years, 10-year window.
Yeah. So I guess the next part of that is the taxes. If you have that target,
yes, exactly.
You'll have to see after the taxes if it's still
so you want to have your portfolio in a set up in a tax efficient manner in terms of the investments. You also want to look at your income tax bracket, because there's a clawback if you're making, I think, over 65,000, somewhere around that figure. They claw back on your OAS. So you want to look at your tax situation and talk to your accountant primarily with regards to how do I have my portfolio designed in a tax efficient manner. How could I minimize taxes? And I always tell people, you cannot avoid taxes. You cannot. Don't even try to do it. But you can minimize it by structuring your investments in a tax efficient manner.
So would that sort of planning happen also in the 50s, or would it be done later on? Or
no, in your 50s you can start. Exactly.
Time.
You could start doing that in your 50s. It's not set in stone, mind you, because as I said, people are living longer. People aren't even thinking of retirement. Some people, they don't. They think 67 will come and they'll still want to work. So there's no retirement plan for them, or they semi-retire. I mean, if you're feeling healthy and you're well and there's nothing wrong with you, why would you want to retire? That's how some people are thinking.
I've seen people working in their 80s or 70s.
Some people, they continue to work. The other side to that, though, is that if you don't have a proper retirement plan, you may not have money at retirement, so that's why you have to work longer. So there's another side to that as well. Without the plan in place, people are working longer because they have to.
Yeah.
That's the other side of it. They have to work longer because they still have bills, because there was no plan in place. I've had individuals in their 50s taking a new mortgage when they should be winding down. To each his own, but some people are working longer than they should because they have to, because there was no plan in place, or it wasn't thought of, as a matter of fact.
So is it, well, I'm using 65 as a proxy, even though it's
actually 67 now.
Even though it's changing.
Yeah.
when you reach that age, and assuming that you're not working, but like if you are, this wouldn't apply, but that retirement check that you're getting now has to last.
Exactly. And now lifespan is at like so much more now, because you're looking at about a 30-year window now. That money has to last you for 30 years. So you have to take that into calculation as well. You know, but lifestyle is important, because if depending on your lifestyle, the money, you know, like I said, if you want to travel a lot, you need more money.
Yeah.
If you don't plan to travel a lot, it won't be much. What if you pick up a new hobby? For instance, what if you have to go into a long-term care facility? You know, like my grandmother she's 94 years old, and she's been there just about, I don't know, 5, 6, 7 years. She went a little bit later, but there are people who've been there since they were 65 because of some disability, and they're in their 80s. So their retirement check is going to the long-term care facility, basically to take care of them. So that's why it's important to plan.
Yeah, definitely.
Yeah.
Okay, we'll take a short break for a few minutes, and we'll be back, and we'll continue about retirement and estate planning. And we're back on the Cube Talk Show with Ken Thomas from Investors Group. We were talking about retirement planning, so now let's get to the next stage, which is the estate planning. So the death and taxes saying, we're going to look at both of them. So when somebody comes and says, I'm planning for my estate, what's the first basic rule that you would tell them?
Well, we normally do, I would do a review of what they have, all of their assets, look at their beneficiaries, see what their will has, and then do analysis. What are you leaving for your beneficiary? Because estate planning is about taxation. Death and taxes are two things you cannot avoid. The taxes, you can minimize the taxes. So estate planning is about managing the taxes upon your death, and transferring your assets to your beneficiary in a tax efficient way. So I'll give you a quick example. I met this gentleman. He's 70 years old. He wants to leave his assets to his 3 children. So he has RSP money, he has RIF money, huge RSP portfolio of about over $800,000-900,000 in RSPs and RIF money. He got some money from his spouse who passed away. He has 3 rental properties plus his residential property. So he said to me, upon his death, he wants the children to have the property. The property is in his name. They're not in the children's name. So I explained to him, upon his death, there's going to be capital gain taxes because the properties are solely in his name. He did not want to put the property in their names for whatever personal reason. So I said, you are going to have taxes, capital gain tax, and you're going to have tax on your registered portfolio. There's no spouse to have as a beneficiary to roll it over. So he's going to put it through the estate. So there are going to be estate taxes, going to be capital gain taxes as well. So what I suggested to him was that, why don't we find a way to pay the taxes so the kids don't have to pay the taxes? He didn't want them to pay it anyway, so we looked at a universal life insurance policy for the amount of projected taxes he would have to pay upon his death. So that was one way that really covered. So we see where life insurance, particularly universal life insurance, can help minimize the taxes on the estate for the beneficiaries. The other thing you could have done, I suggested to him too, was put the kid's name on it as well, but he didn't want to do that for whatever personal reasons. I say, didn't really want to do go that way, even gift it to them. So he opted to do the the universal life policy, and he had to make some adjustments with his will as also. He has a will, but there was no power of attorney on his will in the event anything were to happen to him in terms of making decisions. So he had an executor for his will, but the executor and the power of attorney, I normally would think it would be the same person, but in his case, he wanted to have somebody totally different as the power of attorney to make decisions in the event that he was, he got sick and he had to be, or he went into a coma and stuff like that. Estate planning could be big, but it depends on the assets that the individual has and how it's set up, because you could do a donation as well. He didn't want to do donation. That's one way of minimizing the tax on your estate as well. But his thing was just simply leaving the property and his RSP and so forth for his children. How could he leave it for them without, that big tax bill?
So you mentioned a bunch of things in there, so I'm going to start asking about them. So I guess the first one is, if somebody doesn't have a will, I think everyone knows what a will does, but
yeah, if you die without a will, you're dying in a state without a will. There is a rule with regards to with will. If you don't have a will, it's in a state, and the government could come in and make decisions for you that you may not have intended to have. That's just a basic thing that could possibly happen if you do not have a will, because a will says what you want, what you would like done upon your death, with your assets, or what you would like done with your body, as a matter of fact. So having a will is very, very important in terms of even the whole estate planning.
And the other ones were powers of attorney.
Right, the power of attorney. You can have a living will or a power of attorney. It could be a full power of attorney or partial, but it simply states that if anything were to happen to me and I were not able to make decisions on my own, I would like you to to make decisions for me. Or even if I can make decisions, just certain decisions I would like you to make on my behalf. So you find that people who are in long-term care facilities, for instance, they have a power of attorney, like the son or the daughter or somebody, to make transactions for them in the bank, or if they have investments, they might be able to communicate with their investment advisor, or so the kids may do that, or the husband or the wife, they may be the one doing that. So that's why you give a power of attorney to do that. The power of attorney could be for your health. For instance, you could have specific ones for your health, for your investments, for real estates, or you could have a full power of attorney.
That covers all of them.
That covers everything. Okay. But most times, like I have a living will, a power of attorney that says that, if I were to be placed in a hospital machine or whatever, I don't want to be hooked up to this machine for ever and ever. Maybe after 3 years, I just want to pull the plug. There's no point, Also, that I want my, if I have organs that I'm an organ donor, give it away. Give it to somebody who would benefit from it. Why keep it? But that's as part of my will as well.
So as part of this, you mentioned life insurance as a way of minimizing taxes. So
right.
When should somebody, well, I guess a question I'm curious about is, that 70-year-old
yes.
gentleman you were talking about, was he able to get life insurance?
Yes, he was able to. It's strange enough, he's a very healthy 70-year-old. So he
Okay.
was able to get the life insurance based on his good health. He got a gold standard. So he was actually really healthy, and at his age, it would be more expensive. Had he thought about that when he first purchased a property, or had he gotten proper financial advice at that time, it would have been way less for him. But again, when people buy properties and they're thinking of leaving it for the kids and so forth, you've got to look at the taxes. You've got to look at the taxes. But as some people think about that stuff late in life,
Yeah.
But life insurance is like it's a hedge around your portfolio investments. So universal life is one thing that we talked about with regards to estate planning. But you have critical illness insurance as well. That could be part of your financial planning as well, because with critical illness, it's in the event of cancer, any critical illness that you may get along the way, it protects you. So let's say, for example, you do $100,000 coverage. Depending on your age and your health and so forth, the premium is determined. So let's say you were diagnosed with cancer, a critical illness, a cancer would definitely, it would cause you to die. Most likely you won't die anyways because of new medical discoveries. You would get your $100,000 after 31 days. You have to survive though. After 31 days.
31 days?
Yeah, you would get that $100,000 to do whatever you want to do with it. Now, mind you, cancer treatment, it's really expensive. So all the money you would have had to put out for treatment and so forth, you don't have to worry about that. You don't have to worry about a lot of things actually with that money. Now, if you never got sick or you never diagnosed with any type of cancer, you can get back all the premiums that you paid, whether it be after 10 years, 15 years, or at age 60, depending on when you actually have the critical illness insurance. It's almost like a no-brainer in a way, but the critical illness insurance came about because it was tough on families to pay for the bills, the medical bills. And the thing is, when you're not well, you don't want to focus on the bills, right? You want to focus on getting.
It's the last thing you want to think about.
Yeah, you want to focus on getting better. Also, you want to look at long-term care insurance. It helps because with long-term care insurance, again, you pay a premium to get an income if you were to go into a long-term care facility, or even if you were just you wanted to stay at home. With the long-term care insurance, the money comes to you tax-free on a monthly basis, so you don't have to, and it's tax-free. And it's relatively cheap, to be quite honest, but it could be difficult to get based on your health, because again, some people to take it at age 60 when you could take it at age 50, but as you get older, depending on your family history, you could become sick, or you may have certain illness within your family. So I tell people, the life insurance, the universal life, the critical illness, the long-term care, the disability insurance, these things you should do it when you're healthy, when you're doing okay. And people ask, well, when should I take it? At age 20? Should I take it at age 30? Again, when you sit and you look at do a financial plan, look at your budget, how much money can you afford? Is there a need for it? What is your insurance needs? What type of insurance do you need for your life? It's going to be different for everyone, but I always think that everyone should have some sort of life insurance and critical illness minimum.
So are these for a certain amount of time? Critical illness, long-term care, or is it like a life?
Yeah, so the life insurance, you could have term insurance, or you could have permanent life insurance. Permanent life insurance is for the rest of your life. You pay a premium for the rest of your life. The term is temporary, so could be 10 years, 20 years term insurance. They all have their purpose as well. And then you have the critical illness. It could be for life, could be up to age 65, age 75. Again, it depends on, again, your family history, the need for it for your life, and then the long-term care, of course. I'll give you an example with the long-term care, when you probably would need to have it. One of my clients, their mother had Alzheimer's at age 70. She passed away about a year ago at age 91. So for 20-something years, she was in a long-term care facility. And the children, they had to actually come up with additional money to pay for that. She has 3 daughters, and I'm not 100% sure about this, don't quote me, but it seems that the gene for Alzheimer's is passed on to the girls. So I was just sharing with them, it might be a good thing for you guys to get some long-term care insurance, but they declined. They just said, well, and I said, well, look at the experience that you've had with your own mother. How costly it was for her for all these years until you guys had to take money out of your pocket, out of your own investments to help pay for the long-term care facility. So in that case, I think they should have considered it. But as I said,
it just really depends.
Yeah, they won't. If they were to be diagnosed with Alzheimer's, they won't get the long-term care facility. Insurance.
So, is there any other insurance that's? Well, I guess I could ask you this: for life insurance, is there any other uses for it? Like, can you use it as an investment, for example?
Yeah, you could use life insurance as a retirement tool as well. So, let's say for a business owner, for instance, I could use it as a business owner. Let's say a business owner buys a whole life insurance policy, like they pay for the next 20 years, for instance. The cash value build up in that insurance policy, they can actually use that as a retirement money for retirement. It depends on the amount as well. They can actually borrow the cash value.
Okay.
And treat it as a income. That's just one way. The universal life insurance policy is actually an investments as well as an insurance policy. So there's an investment side to it as well. Some families have taken out whole life insurance policies for the children, and they use the cash value later on when they're older to fund their university, for instance. So there are lots of uses for the life insurance. I have found that, not now but always, that the living are always paying the debts of the dead. And that's the truth. So you should have some sort of life insurance policy, even if just to bury you or to pay your debts when you pass away. People say, well, they'll find a way to bury me and the bills will be paid, that kind of stuff. I think responsibly you should have some sort of life insurance, 25,000, whatever, but have some that that will cover your burial costs and your final expenses, minimum.
So anything else you could say about the estate planning? I guess life insurance can be used for taxes.
Yes. Yeah.
Is there any other methods that are available if you're going to cover a big tax bill on?
As I said, depending on the assets that you have and how it's structured, it's good to have the life insurance for that tax bill. I always believe that having basic life insurance benefits you in the long term. You need life insurance when you buy a property. for instance. I don't believe in mortgage insurance. I believe in life insurance because it's better for you. The mortgage insurance benefits the lender. It doesn't benefit you overall, simply because it's a declining coverage. Whereas you could buy the life insurance and it stays the same, the coverage stays the same for whatever term. As I said, the critical illness, it's a living benefit, so you benefit from it. Years ago, people were complaining about life insurance. It's not for you, it's for the beneficiary, you know. You get nothing from it. That's what I was saying. But now we have critical illness. You benefit from it. Disability insurance, you benefit. Long-term care insurance, you benefit from it. Life insurance, yeah, your family, your beneficiary, they benefit from it. The thing about it is that people don't realize how much of a benefit life insurance can be for their families. I had this one gentleman who was in his 30s, 40s, who had no life insurance. And I approached him and he said, well, he was young and healthy. Why would he need life insurance? And I said, well, it's really for your family. Because he had a wife and children. And he also had a mortgage, but no life insurance. And he passed away. Did he pass away from sickness? No, he got into an accident. And because of that, there's nothing in place. What do you think happened to his family? 2 young children, wife, a mortgage. His wife had to sell the property and move in with the in-laws. So is that what you want for your family? So I mean, I was saddened that that happened, but that's some of the things that happen when you don't have life insurance. If you don't look at your life insurance needs, and people also talk about the cost of life insurance. It could be costly depending on your situation, but let's sit down and talk about it. Let's look and see what you can afford. Rather than have absolutely nothing. So it impacts on your family. I've had husbands who said their wives don't need life insurance. Their wife is home taking care of the kids. Why would she need life insurance? If something were to happen to her, you want your kids to be taken care of, unless you find a wife tomorrow, the next day. But you want to have something in place. In case something happens to her. So there are lots of reasons why you should probably look at life insurance as part of your financial plan.
So we have a few minutes left. If people want to contact you or get more information or get specific information, what if you'd like to give an email?
Well, you can contact me at ken.thomas@investorsgroup.com, or you can just go on to our website, www.investorsgroup.com, or you can contact me at 416-695-8600.
695-8600.
Yeah, 8600.
Is that direct to you?
My extension is 283.
283.
What I try to tell people, have a plan for your life. That's my last word. Have a plan.
That's what sums up.
Have a plan for your life, or else you will be living without purpose. And financial planning is extremely important to your success, to the quality of life that you want to have for you and for your family. Without it, you can see the chaos that takes place in life. You see the chaos when people die and there's no life insurance, no estate planning was done, no long-term care facility, and life is so short. We might as well plan, put something in place in the event something happens.
It's very good.
Yeah.
So that's our show for this evening. This is the Cube Talk Show, and it's a money show. It airs at 10 p.m. Eastern Standard Time on thatchannel.com, and I also have it on my archives on my website, www.joelyinvestor.ca. And it's in the media tab and it's the Cube Talk Show. To contact me, my name is Joe Barbieri, and my email is joelyinvestor.today@gmail.com. And also my social media links are on my website, www.joelyinvestor.ca. Thanks for watching. Have a good evening.